Welcome back to Boring Currency. We need to talk, because if you've been watching silver, you're not wrong. You're just watching the loud story. For the last few weeks, we've all watched vaults drain, mints tighten, and price rip upward like it's late for something important. That silver squeeze is the most exciting story in finance right now, and it deserves attention because it's real and it's visible. Japan isn't just another country. Japan is the funding floor under modern markets, the cheap money base layer that kept leverage alive. For decades, Japan was the land of near zero rates, where money was basically free and the world got addicted to it. That cheap yen didn't stay in Tokyo. It leaked into treasuries, tech stocks, crypto, real estate, every trade built on easy funding. Now look at Japan's bond curve. It's moving in a way Japan hasn't seen in decades, and that's the tell you can't ignore. If you live in the United States, you might shrug and say, so what? Our rates are higher than that. That reaction is why this is dangerous. You can't judge Japan by US standards. You have to judge Japan by Japan's system. For 30 years, Japan has been the country of zero interest rates, pinned to the floor by the Bank of Japan. Those rates weren't just policy. They were life support for a zombie economy, and every balance sheet learned to depend on them. So in Japan, a 10-year yield at 2.34% isn't just high, it's an economic heart attack because it breaks the math. So this isn't healthy normalization. It's a country that can't afford higher rates, getting higher rates anyway right now, with no easy escape. When the BOJ steps back from supporting bonds, prices drop and yields jump. Japan had to choose, save bonds or save the yen. They chose the yen, and that choice changes the global cost of capital because Japan sits underneath global liquidity in every asset class. Here's where it gets bigger. Japan is the world's creditor, the rich uncle of the global economy that has been writing checks for decades. For years, Japanese savers and institutions faced near zero yields at home, so they chased returns abroad like water finding a slope. They bought US Treasuries, foreign bonds, and major US equities, becoming a foundational buyer that quietly supported So capital starts coming home. This great repatriation is a vacuum cleaner on global liquidity, pulling money out of overseas markets. When the biggest steady buyer becomes a smaller buyer or a seller, markets don't need panic to fall. They need missing bids. And there's a second punch. Selling US assets returns dollars, but Japan needs yen. So dollars get sold and yen gets bought. That flow strengthens the yen, and it squeezes every strategy that depended on a weak yen staying weak, especially leveraged ones. Now we hit the leverage engine, the yen carry trade, the most important trade most people never talk about on YouTube. For years, funds borrowed cheap yen, converted it, and bought everything that went up: tech, crypto, real estate, long-duration risk at scale. It wasn't genius. It was free funding. When borrowing costs are near zero, exposure becomes the strategy, and risk feels invisible.
Bottom low. Into the ting. Shame. Shot.
If you borrowed yen, you owe yen. When yen rises, your obligation grows, even if your assets don't move at all. That's the margin trap. To repay yen loans and meet collateral calls, traders must unwind, meaning they must sell what they bought. This is why volatility feels contagious. The selling is forced, not emotional, and it spreads through every liquid market first. Japan's rate shock becomes the pin that pops the everything bubble, because the bubble wasn't one asset, it was cheap money itself. Now the threat turns specific. Japan's biggest institutions are sitting on bond losses as JGB prices fall under rising yields. The script flags a number that should make you pause. Roughly $500 billion in potential US equity trimming from Japanese whales. not day traders, not retail, whales, pensions and insurers with mandates, timelines, risk committees, and no patience for drawdowns, right on schedule. And it's not framed as a one-day crash. It's a slow, methodical liquidation over 12 to 24 months, selling into every rally. That's worse for retail psychology because it keeps offering hope. Small bounces invite buy the dip, then the seller hits again.
Every time the market lifts its head, structural selling can cap upside, grind prices down, and turn breakouts into fakeouts.
This creates a permanent headwind, lower highs, lower lows, and a slow machine that chews up leverage and confidence together.
Retail gets tempted to become exit liquidity. The warning is blunt. Don't hold the bag for sellers who don't have a choice. And tech isn't the only risk zone. When leverage unwinds, crypto often behaves like a risk asset early, sold for liquidity.
You might even see silver rising while Bitcoin falls, and people get confused. But the first wave is mechanics, not narratives.
Margin calls sell what's liquid first. Fundamentals and long-term theses don't matter in the first wave of forced deleveraging, when the calls hit.
Now we get to the elephant in the room. US Treasuries, the bedrock asset that props up the entire global financial order. Japan is portrayed as the largest foreign holder with over $1 trillion in treasuries. That's not trivia, that's structure for the whole world. If Japan stops buying, or worse, starts selling, bond prices drop and yields spike. And higher yields So who replaces Japan as buyer of last resort? In a panic, there's only one entity big enough to absorb the supply: the Federal Reserve. Not because it wants to, but because it can't let auctions fail or yields spiral into a funding crisis. So it prints dollars and buys bonds, whatever they decide to call it this time. The label changes, the mechanism doesn't. They won't say QE, they'll say stabilization or liquidity support. But it's debt monetization in a clean suit, under any name. And debt monetization solves one problem by creating another. You fix liquidity, but you debase the currency and punish savings. That's the closing pivot. This stops being a bond story. It becomes a dollar story: purchasing power, wages, and real wealth. And now the map redraws into two zones: paper assets as danger zones and hard assets as lifeboats in monetary stress. Bonds are promises to pay. Stocks are discounted future cash flows. Cash is a melting ice cube when printing returns. Hard assets are different. Gold and silver aren't someone else's liability, and they can't be printed into existence, not on command. And this loops back to silver, not just solar panels. Silver gains a monetary premium when confidence in paper claims erodes. In this framing, gold is the shield, silver is the sword: smaller market, higher beta, and sharper repricing when flows hit. So what feels like wealth destruction is really wealth transfer, out of leveraged paper claims into commodities and real things.
And Japan, an island nation with limited resources, has every incentive to secure physical inputs as paper markets wobble, and it matters.
But before we close, a quick community warning. Copycats steal scripts and avatars, then push scams on socials and DMs. We have one channel. We don't DM you on WhatsApp. We don't sell crypto on Telegram. Protect yourself and the community.
If you value real analysis, share this and comment, staying with the original so the algorithm knows you're here, right now.
Back to the point. The anchor is snapping, capital is reversing, and the slow grind phase is already starting, for months. Don't wait for a headline crash to act. This is a process, 12 to 24 months of pressure that destroys complacency. The first drops feel like normal volatility. The next feel like concern. The last phase feels like panic, because bids vanish. You want to exit the burning theater while the movie is still playing, before the doors get jammed and everyone rushes at once. So watch Tokyo's yields like a countdown clock. Every basis point higher tightens global funding another notch, for everyone, everywhere, at once. And watch the Fed's posture like the endgame signal. When support turns into printing, the repricing accelerates fast, very, very quickly. Silver isn't the whole movie. It's the insurance policy for the finale. when the system chooses debasement to survive in real time.
The phone is ringing. Japan is on the line. The question isn't whether this spreads, it's whether you're positioned before it does.